Hey traders, welcome to Charts and Coffee. Great to see everyone. All right, great to see everybody. All right, hang on. Camera's a little glitchy. Bear with me one moment. We'll fix that right now. All right, there we go. Okay, so great to see everybody. Welcome, welcome. Happy Thursday. Hope everyone's doing well. We are just one day from look, end of quarter and end of month, things have started moving and grooving about anywhere from 2 to 7 days ago. The last 3 to 8 days of end of month, end of quarter tend to be where that rebalancing, reshuffling, reallocation, everything, shenanigans start to take place. And so we are just coming into the very end of that. So like the end of anything, like in high school, last hour of the party before someone calls the cops, that's the window we're in right now. So please be very cautious about moves. They may not make a lot of sense right now. What I'm most concerned about, and I will continue to vigilantly keep an eye on it, is whether or not we get any significant rollover in tech, namely NASDAQ, XLK, XLC, XLY, SMH, and any movement into some of the names like our more defensive dividend yielding type sectors, XLP, XLU, XLE, XLRE, and even whether or not some of the laggards within the S&P, like financials, XLF, and healthcare, XLV will benefit. So I'm keeping a really close eye on that because in order to rotate, it's not just one sector surging and joining the others, right? That's participation, that's breadth, or whatever you want to, call it, whatever the terminology is that you use. But rotation is something else is seeing profit taking while something else sees the benefit of that bargain hunting from those profit taking dollars, right? So those are all things that I'm keeping a very close eye on. You know what? Nothing may happen, right? We may not get any significant type moves. It just might be status quo, and money managers are thinking, I'm positioned about as well as I can be positioned, and what I've got is what I want to continue to hold. The one thing that I think gets thrown around, this idea of going to cash. Gang, nobody closes out all their positions unless you're a short-term trader, in which case being flat is a position. For example, a day trader. But I hear this phrase on TV a lot, and it's such as I like to say, it's a back guano saying, which is to say going to cash. No one's closing out their portfolio and sitting in dollars. That's not what they're paid to do. So be very cautious when you hear things like that. That's your bat guano meter basically being pinned to the liar pants on fire reading. Okay, so remember, money has got to find a home. It's not going to go underneath the mattresses, right? Doesn't mean it may not go to dollars, doesn't mean it may not go to treasuries, but we'll see signs of that, right? If that's the case. So keep an eye on that. And let's go ahead and jump into what's going on this morning. We'll take a look at, here we go. We'll take a look at the NASDAQ. The NASDAQ is most definitely the sector that continues to carry others with it, meaning, remember, tech is heavily weighted, of course, in the NASDAQ, but it's also the most heavily weighted sector in the S&P, and it's the second most heavily weighted sector in the Dow. So tech has a unique ability to affect all three of the indices. If it's weak, it's not as if the S&P and the Dow can't move higher. It's simply that they're going to need help from the likes of financials and from healthcare to do so. So keep that in mind as well. What has to compensate if tech, right, starts to move lower? And then what do we need to avoid, right? What do we need to avoid? And that's where, one of the things that we've been doing in the day trading, whether it's the futures room or frankly, the Sector Secrets Mastery room, is I'll look for the outperforming sector within the index. And a lot of folks don't know, in an ideal world, and a lot of folks don't know, there are sector futures, right? In an ideal world, we're trading the futures on the healthcare sector. But because of the cost and the ease of getting in and out of XLV, these futures contracts like the financials and healthcare and staples, there's there's a futures contract for them, but there's no volume. So I think, well, at one point or other, there was supposed to be the reality where we could trade the NASDAQ, but we can go trade communication futures. It never did take off. I hope the CME hasn't given up hope, because that would be fantastic to be able to trade the futures on those. But lacking that, we can still pivot. We can still say, all right, if I'm taking a look at the NAS, what's the strongest sector within it? Yesterday, we honed in on consumer discretionary. And by honing in on consumer discretionary, the natural index sector stock thinking went from, all right, if consumer discretionary is in gear, then let's take a look at Amazon. Let's take a look at Tesla, right? These are all ways we can pivot, if you will, to the relative outperformer. And sometimes the broader average is not the best place to be, right? Okay, so let's go ahead and jump into some questions here. And let's see. I think it looks like everyone's ready for a semi-long weekend. Reminder that on Monday, we have a half session, which is to say it's a totally phoned-in session. I believe I can't remember which exchange or if it's all the exchanges. We're not allowed to have 2 days, like weekdays off like that in a row. So half day on Monday, which is going to be completely phoned in. And of course, Tuesday, the July 4th holiday here in the States. Now, keep in mind, it's probably going to morph into a 4-day holiday. So Friday is going to behave like a 3-day weekend in many ways. And then, of course, we've got that quirky day off next week. So all the more reason to stay vigilant about managing risk. All right, first up on the questions. Hey there, John. Someone asked me about indicators yesterday, which had me wondering if VWAP with a tick chart is more effective versus a time chart. John, so it's not a matter if it's more effective. I think this idea that we're seeking out the best settings and the best indicators and the best time frames or even chart types is sort of the missing link to our trading. It's actually consistency and risk management. So as long as you apply consistency and risk management to a tick chart versus a 1 minute, 2 minute, 3 minute, 5 minute chart, it really doesn't matter. It's really a philosophical difference. For example, tick charts, point and figure charts, these type of charting believe, right, that time is irrelevant, right? That time is this imposed thing, that trade size, just the last trade, regardless of what time it was placed, is more important. Again, not right or wrong, but that is not something I believe. I am very much a believer that there are 4 factors in the market. There's price, which I think everyone agrees upon. There's volatility, which most folks, I think, probably the lesser used of the 4 factors. There's volume, but I don't use time or date-based volume. I use price-based volume. And then there's time. That's the 4th factor for me. So 4 factors rule the market. I've got to put time in there, which is really simply to say, I don't test that. I haven't tested that because it removes one of the 4 factors that I think is so important. That being said, there are many, 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 many traders that love point and figure, that love tick charts or charts that simply don't acknowledge time as an important aspect to what's being plotted on the chart. So that's really it. Is one better than the other? I would have to say no. It's which chart is presenting you with the information you need to make a decision about entry and to make a decision about exit. And after that, it's really up to us, right? Okay. Let's see. TH says, all right, moving on. I'm looking at XME for Dominion for a swing buy. Okay, sure. So XME for D, isn't D Dominion, or am I thinking something else? XME is your miners. So for those of you, actually, let's pull up the multi-chart here. I know I have this somewhere. There we go. Let's pull up XME on the multi. So what a multi-chart is just a flexi grid on Thinkorswim. There we go. And I put the stocks in order of their weighting. Now, not every ETF is a high concentration weighted one, right? That's one thing. Not every ETF is. So sometimes these are not as needed as in other situations like XME. So you're asking about D. Oh, on the daily. Oh, on the daily. Thank you. Thank you. I was going to say D is Dominion and XLU. Thank you for the clarity, Robert. So if I'm looking at XME on the daily for a swing, here's my challenge with this one. First of all, when I look at something like XME, look at the top 3 weighted names, right? They're all red. The next 3 weighted names are all green. This is going to be one of those sectors where I would say it makes a lot of sense to go to the individual stock level, go from the tide to the boat, right? Rather than playing XME, Robert, on the daily, look at the individual stocks. Now, the next step is, are you more bullish or bearish XME? That's going to then dictate your bullish watch list and your bearish watch list. And that's where, if you're thinking, Rag, I want to be short, cool. I don't disagree. We're still below the 200 exponential, Newmont Mining, etc. are red. That's your watch list to the downside for short the rip or get long puts on the rip. When you look at something like Freeport McMoran or Nucor, those are your names. There's 5 of them that would be potential buys, buy the dip. So I think at this point, I would go down to the individual stock level, and I would figure out which direction I want to trade XME in, and then I would go with an individual stock. All right. Okay, from our free trading room, we've got a question from Earl who asks about the XLU technicals. All right. So before we get to the technicals, Earl, I think it's really, really, really smart to make a pit stop at the actual stocks weighted within the XLU. Frankly, far more important than the technicals, because what we have here is the composition. You know, I like to think of it as boats and tides. Some folks do and don't resonate with the analogy, and that's cool. I'm in South Florida. Maybe that's some geographical bias, but another way to look at it is if XLU is a motor and every one of these stocks is a cylinder, right? And we want to ultimately have more cylinders firing in the same direction for the motor to be operating as best it can. If I see something that's sort of missing, right, that we don't see either organization well to the downside or organizational well formed to the upside, I'll usually go down to the individual stock level. So long before we get to the technicals, I'm going to look at the composition of XLU and say, this thing's under a lot of pressure, right? NEE, Nextera, the number 1 weighted stock in it. It's choppy at best, and it's well below the 200 exponential. Duke's in a downtrend. You're probably your most bullish look in this group. Anything that would suggest even a glimmer of support would be Southern, SO, because it's sideways, but it's perched above the 200. It's above the equator. It's in the bullish hemisphere, but everything else is really bearish. So before I get to the technical breakdown, I'm going to start with that. Now, what I'll do is go to the daily time frame of the XLU, and we can get a look at the market structure and levels and Darvis and all that good stuff. All right, so the market structure is sideways. We're below the 200 propulsion. It's really quite a mess. So I would say, once again, not that dissimilar to Robert's question, right? Where we're looking at a broader group of stocks by way of their sector ETF. I could break this down and say, all right, what's a good way to find the relative performance or the best clarity? I think it's going to be at the stock level, Earl. So I don't know that I really want to focus on XLU itself, but rather maybe if I'm bearish, NEE, Nextera, which really, for all intents and purposes, is what XLU is going to do. But if I'm thinking there might be a shot at some bullishness, I might pivot then over to Southern and try to find opportunities to get long there. So again, when you have a sector where there's a lot of different looks at strength and weakness, it makes sense to put together a relative outperformance list, both bullish and bearish, and hone in on that. Now, if we had either one of these two sectors in an uptrend like XLK, like XLC, like XLY, a lot easier to play this tide than having to go down to an individual boat level, because there's plenty of clarity there. There's plenty of reason to say, look, I'm going to buy a dip here. And if I'm going to buy a dip here, I might even move into buying a dip in any one of the heavily weighted stocks within it. So I'll always start with composition, Earls. I hope that makes sense, right? I think ultimately, when I want to understand what's going on with XLU, I lift the hood, I look under the hood, and I say, all right, what's going on there, right? And that's where I think we always need to remember that there's going to be ultimately some one bullish symbol and mostly bearish. I'd probably be playing to the downside. So then Earl follows it up with looking for macro clues from weakness in the XLU. Earl, any other time of year other than the end of quarter, Earl, I totally get what you're saying. Does it make sense to look at defensives? Now, macro, there's two ways to use this word macro, gang. It's become a slang, interestingly enough. There's macroeconomics, which I would not apply to XLU, macroeconomics meaning growth, jobs, inflation. And then there's the macro, which is sort of that 40,000 foot view. I'm presuming, Earl, you're thinking about the latter. But, even the macroeconomics of interest rates could affect XLU. But here's the bottom line. XLU has been lagging, right? When you take a look at the major sectors, XLU has been lagging. And if you look at who else has been lagging with it, and I wrote up a bit about this in This Week in the Markets newsletter, they're mostly dividend yielding names. Risk appetite is in tech right now. And oftentimes on the other end of the sort of the disinterest of tech flying higher is traders don't feel that they need to be moving into defensives. XLE is more defensive than XLC, right? Energy is a higher dividend yielding name. Now, most people may not consider XLE defensive, but to me, anything that has typically a dividend is going to probably be more likened to a defensive type play. XLU for sure, along with XLP, would be two defensive corners of the market that are lagging. In my mind, if I'm looking for that 40,000 foot view, Earl, we need to see rotation out of the outperforming sectors, XLK, XLC, XLY, and I want to see then either financials or healthcare or those dividend yielding sectors benefit. So I think a lot of that would probably have to do at this point in time with the sector rotation. Then after that, I would say, oversold buys in a neutral environment using a slow stochastic and the daily price movement ranges would suffice, right? That would suffice. We can move on to more technical based ideas. So I would just wait out end of quarter, maybe start doing this Wednesday of next week and say, okay, end of quarter is in the rear view mirror, whatever adjustments have been made. And now I can just start to treat XLU as not necessarily something susceptible to sector rotation, but something that's going to trade along the lines of its underlying market structure and the indicators, the indicator readings. All right, next up, do I see an opportunity to have a trade rule when the 20, 50, and 200 simple moving averages merge? Do I have a trade rule? Dave, I don't use those moving averages. And so it's not to say that they're not useful. It's kind of like the earlier question about tick charts versus time-based charts, right? I don't use them mainly because, well, two reasons. One, I think from testing, there are other moving averages that outperform 20, 50, 200. 20, 50, 200 are fantastically old school indicators, right? If you would have talked to me back in 1990, right, when I was pretty fresh I was trading for maybe about 2 years at that point. 1990, 1991, everybody looked at 20, 50, 100, and 200 simple moving averages. Everybody. It was the staple. Fast forward from there in my trading career, I prefer to look at exponential moving averages because they tend to reflect a certain amount of recency bias, because exponential moving averages weight the closes that are more current, that are more recent, heavier than older closes. So if I look at a 200 simple, every close across the last 200 periods is weighted equally. In an exponential, the more recent closes are weighted heavier in the average. I like that recency bias. So that's the first thing. I use EMAs, not SMAs. Again, just preference. And then as far as the different moving averages go, anyone who follows my work, I'm a big fan of Fibonacci-based moving averages. So I like using things like an 8, 13, 21, 34, 55, even 89 exponential moving average. And they just tend to work when I look back on where dynamic support and resistance are. I know some traders like to use moving average crosses. So if the 20, the 50, and the 200 cross, it does all sorts of things. Again, that's fine. It's very old school, which is great. I love old school stuff. But again, back testing has told me there's better ways to do it. And I've already employed moving average crosses into the multi-trend. So rather than having to look at a bunch of moving averages, strewn across my chart like spaghetti, I got enough spaghetti here. Acknowledge my secret squiggles. I try to take those moving averages and I plug them into these 2 rows of colors at the bottom of my chart, and those are the multi-trend. So those numbers can be changed, right? If I want to change my multi-trend to look at the relationship of 4 different moving averages, I could, but it's built in with those exponential moving averages based on Fibonacci numbers. So anytime I say don't use something, it's simply because I think that there's something I could use better, right? Okay, gang, as always, thank you so much for joining us for Charts and Coffee. We start every morning at 9 a.m. Get your questions in early. I take them first come, first serve. I'm actually late. I will see you all tomorrow. Same time, same station. Be good to each other.